It'll change the kind of the fabric of price discovery in terms of what options create in the contour of kind of liquidity gaps. But it's all to say that more adoption in that format is still net delta that's coming into Bitcoin, which I think is a really positive thing.
So we've mentioned lending out Bitcoin, and it's becoming more accepted as a collateral. People call it pristine collateral. We've mentioned the selling options as a way to get yield. There's also the carry trade with the futures. Are these the only ways to get yield? Two of them seem to cap the upside. Are there any other sources of yield, or is lending in particular really the big one and the one that doesn't cap the upside?
You can generalize out the futures derived source of yield, where you're borrowing against your Bitcoin and putting on some kind of delta neutral trade. You can expand that out to a whole variety of cash and carry type trades. What you really need is you need a great source of credit, a great line of borrow against your Bitcoin, and whatever your borrow cost is struck at, that's your hurdle rate. And then you can take that cash and go deploy that in any other cash yielding strategy that you really like. Of course, you have to manage your duration risk and your collateral risk, so there are some complexities to that, but the world of cash and carry trades is wide open.
Are we seeing these strategies being deployed by, Quamid? You mentioned the 195 companies with the Sunny balance sheet. Like, is it just and Jeff, this would be a good one for you too, but is this just sitting down on balance sheets or right now, or are we actually starting to see this BTC being used as a productive asset with some of these strategies?
Yeah, I think the short answer is yes. But I think it's still sort of like nascent, right? And what we've been focused on, frankly, with Aquilon is the opportunities to sort of work with corporates, work with institutions, to think about ways to how to bring their assets, treasury-backed assets and things of that nature, on chain, and help facilitate those transactions where there's increased demand across board, for example, in APAC, and facilitate those types of transactions. So, I don't really have much else to offer on that point, but that's kind of where we've been focused.
The DATs have done some of this, right? The digital asset treasury companies have gotten pretty involved in trying to figure out how to monetize their treasury, and they have clear incentives to do that. They can, of course, raise assets through equity offerings, but many of them have debt that they need to pay, and so they need some kind of yield off the treasury to fund their debt costs, generally speaking. So those folks have been pretty active about option selling, and doing kind of covered call selling has been a pretty common strategy in that space. Some of these more complex derivative-based strategies or cash and carry strategies have really not been tapped into by most of those folks. They tend to require multi-counterparty and multi-venue relationships, so they fit pretty naturally inside of a hedge fund or a commingled fund structure. You can do some of these in separately managed accounts, but generally this is where you really need like an institutional quality asset management team to help facilitate some of these. But that's kind of the gist of it. The yield strategies, they're pretty common these days conversationally. There's not that much Bitcoin that's been deployed to work in them yet. Part of it is it's really hard to earn a yield on Bitcoin, so that it takes a lot of work. And this is where the kind of professionals really are driving most of the efforts these days, and the DATs and the large token holders are mostly partnering with those folks to get those kinds of trades done.
Yeah, that's right. I think the common saying in crypto as it goes, if you don't know what the yield is, you're the yield, is the mantra that drives a lot of the cynicism of the participants. And as I mentioned about price risk, aspirational risk, and technology risk, the truth is most people have a very specific view on one of those three things at any time. No one's going to say, I want all three of them. And so the challenge and the opportunity for these permanent capital vehicles that are DATs is you have to figure out which lanes you want to play in and which ones you don't, because in a way, by doing all, you might actually be favoring nobody. And that's kind of the world in which people have specific views about the kinds of risks they want to take upon. So at Bitwise, One of the biggest success has been around options trading because I think people are really able to understand it because they know the source of the yield is coming from the trade-off you're making about certain path-dependent participation rooted in volatility, and they get that. Like quantitatively, they understand it. The jump gets a little harder with lending strategies because the unknown unknowns of counterparties and balance sheets is actually the stuff of dreams in the financial crisis as they are today. So who's to say crypto is going to do better than what Lehman Brothers did? It's hard to know. How do you underwrite that particular risk? We think crypto actually has better ways to do it because of its transparent nature and how these things can be disclosed. But I think that's always a journey and a work in progress. And the third that I think has been most challenging is to get people to use Bitcoin and go on chain, like use Lombard Finance and actually try to generate Bitcoin on Bitcoin type yield. Because even as Sarah said, when people talk about like 2% Bitcoin on Bitcoin yield, they're like, oh, that's not interesting. But it's super interesting because actually—
No one appreciates how hard that 2% actually
Oh,
is.
100%. It's super interesting because we're also conditioned to think about dollar-based yield. So anytime the number looks low, you're like, 2%. But it's 2% like Bitcoin risk, right? Like it's like Bitcoin capital accumulation. And that native concept of thinking about a funding currency that is the return in which you're earning is not familiar to most people. Like you don't buy Microsoft and think about your dollar gains and units of Microsoft that you get, right? Like, but that's actually what Bitcoin is. And so for those who do get it, it tends to be the crypto native crowd, and where Bitwise has had the most success in having clients access Morpho vaults to have an investment manager touch upon this is probably within the crypto native segment, and they want that yield. They don't want options trading because they don't want to be holding Jane Street's bags, but they want that yield, right? So there's a whole kind of, I think, menu of options that cater to people's ethos, their personal convictions, and their interests.
So with that, and we mentioned it's nascent right now, and it's difficult right now, and it's cyclical right now. In 3 to 5 years' time, let's just say 5 years. In 5 years' time, are we seeing Bitcoin's role as maybe not lesser, but just lesser of a speculative asset, lesser of a store value, maybe more of a productive asset where you could start to earn yield on? Does that start to become more of its advantage over something, let's just say, like gold?
I don't think those ideas are actually different. I think they're kind of the same. If you think about Bitcoin being accepted as a collateral asset, you're really talking about it being a high quality treasury and reserve asset that you're then putting to work. So you're really doing both at the same time. You're expressing a preference for keeping your Bitcoin stack untouched and as a part of your core strategic holdings, but you're working with partners that are helping you extract a little extra value out of it, compound your Bitcoin return over time, earn that yield on your Bitcoin, borrow cash or stable coins against it, and go deploy that in other places, whether that's to fund your operating needs as a business or redeploy into those cash and carry type strategies. So really, I mean, what's amazing about what we're seeing happen in the industry is Bitcoin's had clear acceptance as a kind of HODL asset, as a store of value, as a way to preserve your wealth. And now we're seeing it gain traction as a working asset, but really through these kind of layered structures that require a little bit of extra operational complexity for sure, but really let you do both things at the same time.
Yeah, I think like that's kind of how I think about it too. Like, what is the practical day-to-day functional use of it, right? And like with gold, like you have to convert your ETF to cash, right? I think in 5 years from now, I think we all hope, right? But at some point, you can take your cold wallet anywhere and transact from anywhere, right? So I think the practical use of it every day is really what's going to cause even more widespread adoption. So that's kind of how I think about that question.
Yeah, definitely the utility is helpful, but I go back also to reaffirm what Sarah said, which is that Bitcoin is uniquely a HODL asset. People love the idea of just holding on to it for a long time. And that's actually its most unique feature amongst all the macro assets I've ever looked at. I'll share 3 stats with you guys to bring some certainty to things that are inevitable, which is what's going to happen into the future about generational liquidity that is going to be moving from the older cohort to the younger cohort. By 2030, it's estimated that all the boomers will be 65 years or older. That's basically 3 years away. They're going to be 1/5 of American population. And in 2034, there's going to be more adults than children for the first time ever in American history. That's 7 years away. By 2036, people estimate that fertility rate in this country is going to be below 1.5. It'll be the lowest it'll ever have been. and that it'll take more than 20 years to recover. As you know, fertility is one of those things, you need time. If you're not having kids today, you're not going to have an adult 18 years later. We know this. This is happening. And eventually, as the older people realize they need liquidity to fund their retirement or whatever it is, that they're living longer than any mortality curve has ever estimated, they're going to have to sell assets to generate liquidity. So the key here is you must own the thing that people are not going to sell. And especially if you're a young person, you have 80 years ahead to hedge and not 20 years ahead. So you want to be on the right side of the trade. You want to buy the thing that is not being sold. And that's why HODL is so important. It goes back fundamentally to the view, people who buy Bitcoin are not in it to sell Bitcoin in the next 20, 30 years. It might change 50 years from now as the young people today become older and they need to fund something. But the reality is, more than likely, something else is going to break first before Bitcoin breaks. And I think that's the thing that we have to know with certainty in a world full of uncertainty right now. Is Bitcoin going to go up? Is Bitcoin going to go down? Is Bitcoin vol 70? Is it 40? It's all important, and we should know it, but it's all noise in that grand construct of what we're going to have to expect 7 to 10 and 20 years from now from a demographics perspective and a generational liquidity drawdown.
Okay, love it. Bitcoin is a generational asset. We are coming up on time, so I just want to do one quick fire round, just very quickly in as little words as possible. If there's one misconception right now about Bitcoin as a role of an institutional asset that you could remove, what is it, and just what is it? Okay, I'm gonna call names now. Sarah, let's start with you.
Actually, I'll call back to what Jeff mentioned earlier, that when folks are thinking about earning Bitcoin yield, the headline numbers are pretty small, kind of mid to low single digits is very common. Folks think that's a small number, but it's really important to remember you're earning that yield denominated in Bitcoin, and so the wealth effect of that is much bigger than folks tend to think.
Okay, Quamid?
I mean, not to kind of like rephrase your question again, but I look at this as, I think we've seen this before in history, right? Whether it's gold or with credit, right? It's a volatile sort of asset, then it becomes like a macro hedge, and it's generally broadly acceptable, right? We've seen that with credit in some instances, and obviously we had the Great Depression after that, but we learned from that, right? So I think this is in the same vein, right? And I think once that becomes more accepted, known, and then the infrastructure around Bitcoin becomes more standardized and widely adopted, I think we'll be singing a different tune a few years from now.
Nice. Jeff, Sarah stole your answer. Any more?
Well, if I could change one thing, I would love Bitcoin to re-enter the minds of the young people. Maybe this is in line with kind of my demographics point that I was making earlier, but you look around this room and myself included, we're older. And one thing I do
watch it.
Yeah, and also, being Asian helps, but I'm much older than you guys probably think. And so, I worry a lot that if the young people forego the mission of Bitcoin adoption, that the whole social contract we're thinking about what this asset means fundamentally unravels. And I do see young people getting distracted away from Bitcoin because something about BlackRock coming in, or something about hitting 100,000,
or prediction markets,
or predictions market. There's other access points to do other income generating endeavors. Maybe it's Zcash, maybe it's something that's 10 cents, but all of these things have started to kind of, at some level, distract the young from the core mission that we're all in this room for. So if there's one thing that I would love to kind of push forward is get more of the younger people still involved and entrusted to realize that there is no co-opt happening at the institutional arena of Bitcoin. We're all kind of in it for the same reasons, and find a way to reinvigorate that energy. Because I truly believe it. Like, if the young people don't come for Bitcoin, like, there isn't going to be a future for it. And so it's all up to us to still make sure that, we communicate that cross-generationally too.
Can I just add one thing to what Jeff mentioned? I also think it's important for the industry not to just speak to itself, right? I think there is a lot of opportunity to do the work across different contexts I keep harping on the regulatory environment because that's a big part of it, right? Whether it's Congress, local government, people need to understand how this can interact with their, not just daily lives, but also their professions and things of that nature. And I think the regulatory environment needs to come on board. And I think we can preach to ourselves, but if we miss an opportunity, if we don't bring the important players across those different, sectors to the table as well. So that's the only thing I would add.
Awesome. Thank you, Jeff, Sarah, Quamid. Thank you very much. Ladies and gentlemen, our panelists.
Thank you.
Thank you.